Yesterday, somebody asked if I would be able to frame up an old school options action trade. So basically talking about a stock and talking about an options trade to go with it. Well, tomorrow, one of the bigger names, Netflix, is going to be reporting earnings, and we're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. And today we're going to talk a little bit about Netflix. So they're going to be reporting earnings tomorrow after the close. Stock is up about 46% over the course of the last 12 months or so. And right now, when I was taking a look at this earlier today, the average price target of the 67 analysts, at least the 67 analysts whose price targets are highlighted in Bloomberg, their average price target is only 3.6% higher than the current stock price. So I think the question we have to ask ourselves is, has basically the best been put behind it, or is there still some potential for further upside here? And if there is, should one buy the stock, or should one use an options trade to make that bet directionally, whichever way it is? And you'll forgive me because, of course, as I previously mentioned, sort of experimenting with setups here, and I'll be back in a proper office setup soon, so I'll have more screens around me. So I'm just fiddling around with a laptop just to make sure that I touch on the critical and important points to make. So the first thing I would say is that Netflix has had its share of naysayers for decades now. I can remember that one of the largest short bets that I had ever seen was in Netflix. It was actually an institutional banking client of ours at the time. They had lost about $250 million on a sizable short bet in Netflix. They then asked me whether I could come up with an options trade that they could use to place that bet because they basically had just too much pain being short the stock. The stock had a huge pullback. I think we clawed back about $180 million of their losses. They put the trade to bed. And it's a good thing that they did because the stock is obviously much higher now than it was then. Let's talk a little bit about what the concerns were back then, some of the more recent concerns, and whether or not those concerns are warranted. So the concern at that time was principally around content costs. So Netflix was growing their subscriber base by leaps and bounds, but their expenses were growing just as quickly, maybe more quickly. And there was a perception that they were essentially buying the content from the content creators, the sort of big legacy entertainment businesses, and then redistributing it, but there was not a lot of margin in that model. Now, as we fast forward to the present day, much has changed as far as this goes on two fronts. First of all, Netflix has quite successfully started to generate their own content. The second thing is that the legacy media companies have now begun to recognize, particularly after the pandemic, that streaming is basically the way of the future. So suddenly we have Netflix as a content creator, and we have the legacy media companies such as Disney and Paramount. Paramount's streaming efforts, as probably many will know, basically kind of flopped lately, trying to compete in the streaming space. Here are some interesting statistics, I think, anyway, and that is that over the 10-year period ended December 31st of 2019, so from basically 2009 to the end of 2019, Netflix had negative free cash flow in excess of $10 billion. It's around 10.4. The exact number, I don't remember exactly, but it was about 10.4 billion cumulatively over that time. In the 4 full years since that time, so 2020, 21, 22, 23, the company has generated net free cash flow of about 10.4 billion. So the 10.4 billion in free cash or negative cash flow that the company had in the 10 years leading up to the pandemic was all made back over the 4 years since. And there have also been two, I think, very important developments as far as Netflix is concerned. So the first is that there was some concern that once the other media companies, entertainment businesses, entered the streaming wars for real, that there was going to be some attrition. And that has not proven to be the case. I believe we have a chart that we can show now, which basically is going to show the subscribers over the course of the last 5 years by quarter. So there should be 20 quarters here. The blue columns represent in this chart the total subscriber base for Netflix, and we can see that the company has essentially been growing that subscriber base quite consistently with or without the total, with basically the competition from other live streaming businesses. And there's something interesting going on here. So the first thing is that Netflix had for a very long time, and it was well known, an issue of user ID sharing, right? So a lot of subscribers were sharing their username and password with others, or there were families that had them, and over the course of time, more people knew what those were. And so there was a sense that there were actually more users or subscribers to the platform, many of whom weren't paying. And so the company decided that they were going to crack down on this. We as a family, we longtime Netflix subscribers, hasn't really impacted us. But one of the things that we've observed is that what you would have expected to happen as other live streaming platforms basically came into competition with Netflix, you might have seen some would migrate. Families that like Disney content might have migrated to Disney Plus, and so on. But in fact, the subscriber chart, as we can see, not only is it quite consistent, and some of that is international, of course, too, but actually recently it has accelerated somewhat. Some of that could be a function of the user ID sharing enforcement that they've been getting into. And you can see in red the net adds in terms of subscribers from one quarter to the next. Now, for the longest time, that was the principal metric that one needed to concern oneself with when you were looking at Netflix valuation, because it was all about growth. It was not about net income. It was not about margins. And it was not about free cash flow. Largely, it was not about free cash flow because the company wasn't generating any. That is no longer true. So the company is now generating free cash flow. This, I think, is also interesting. We take a look at net income margins, and net income margins pre this most recent period, and since if we compare sort of the pre and post positive free cash flow story, the net income margins were averaging in the 9% territory in that earlier period that I was talking about. Right now, the Street's expectation for full year 2024 net income margins is about 20.9%. Okay, so what does this mean? Well, it means a couple of things. One is that if the company is continuing to grow, and actually that growth is accelerating, if the company never generated free cash flow, but now it is, and that free cash flow growth is accelerating, and their net income is accelerating, that in turn justifies, of course, a higher multiple. And in fact, that's what we're seeing. So right now the company is trading around, in round numbers, about 32 times forward earnings estimates. Full year 2025 EPS estimates are in the neighborhood of about $22 a share. And should they achieve that, then I think they're still, believe it or not, net of this huge appreciation we've seen, I think that they are still in a reasonable price to growth territory. Where's the potential problem in all of this? Well, there's a couple of things. The first thing is that what we're seeing today, obviously, some of the highest flying stocks have pulled back. The stock is trading very close to the average analyst price targets. That's, that can actually, we can look at that as both a negative and a positive. You can have a bull case and a bear case around that. The bear case is that the company is fully valued based on the Street's sort of perspective on what the company's growth prospects truly are. The bull case, though, is that there is a pattern whereby street analysts, when you get a company that is growing at on a very good path and actually meeting or generally exceeding the street's growth expectations, that the habit is that the street is always playing catch up. So the stock rises and analysts' target prices rise, rather than the opposite, that the price targets rise and then the stock rises to meet it. And I think part of that stems from the fact that they were underestimated as the 800-pound gorilla in the room, as the outfit that essentially developed the entire space, is the largest in the entire space, and is now the best operator in the entire space. So in the midst of all of this, I really have just two concerns, and that is that, number one, we're seeing a pullback in the growth names generally. The highest flying stocks are the ones that are the weakest performing today. That, I think, is something to be concerned about. There is something else as well, which is another chart which we have, which is a 5-year price chart of Netflix. And one of the things that I noticed as I was taking a look at this is, isn't it remarkable? I actually drew a line on that chart, and what we can see is that just recently, the recent highs essentially match almost to the penny. I don't know if they actually did match to the penny, but that's a comment that Carter Worth often makes, but I rather like that. It does appear that the stock came very close to, or may have matched, the all-time highs almost exactly. Is it a double top? So what are our bear case scenarios here? We have a potential double top. It is a higher multiple name, deservedly based on their growth, but this is a high beta name, and if the high beta names and the high growth names are the ones that folks are rotating out of, which is what appears to be the case to me, some of the best performing stocks of the year are the ones that have underperformed in recent trading days. We have seen some other areas playing catch up. We talked about some of the industrials earlier this week and late last week, starting to seemingly round the bend. By the way, just a little sidebar on that, J.B. Hunt's new CEO, she did comment, even though the stock performed badly out of earnings, that they are beginning to see basically some strength, some sign that the trucking and logistics business is actually bottoming out and rounding the bend, which is exactly the case that we were talking about. Of course, I don't have quite the visibility that she does, but what I was looking at were freight rates as an example of that. So again, the potential double top, the fact that there appears to be rotation out of higher multiple names, these are reasons why one might be concerned, even if the company's operating performance is arguably as good as it has ever been. And they seem to be exercising greater discipline. So there's reasons to like it here, and there are reasons to be anxious here. So with that in mind, and the reason that I decided that this would be the name we would talk about today, in part also because somebody was asking me about it from CNBC, I happened to, earlier today I was saying, okay, well, what's the biggest trade that we saw in Netflix today ahead of the earnings number? Now, there's going to be a lot more tomorrow because they're going to report after the close, but the biggest trade that I saw when I was looking at it much earlier was a purchase of 200 of the July 700 calls. So the regular way July 700 calls, those obviously expire this coming Friday, end of the week. 200 of those traded for $9, $180,000 worth of premium. Now, what's interesting about those calls? A couple things. So first thing is, the options market right now is implying a move of about 8.3% for Netflix. And 700 happens to be about 8.3% higher relative to the $646 or so that Netflix was trading at when I was looking at that trade earlier. And if we take a look at the past 8 reported quarters, what we've observed is that the average earnings-related, one-day earnings-related move was higher than that. It was about 9.5%. And so I thought, well, that's kind of interesting. So maybe this trader was noticing that options are priced as if this move won't be as big as it has been on average over the last 8 reported quarters. And they were targeting that move to the upside, and the fact, maybe it was just a coincidence, maybe 700 is just a nice round number, maybe they didn't notice this at all, but I did. And that is that 700 bucks happens to be, one, the implied move to the upside. Options are cheaper than they have historically been. And so what I did was, I said, all right, well, why don't we just take a look and say, if you could have bought, so those calls at 9 bucks are less than 1.4% of the current stock price. If you could have bought those calls going into the last 8 reported earnings, how would that trade have actually played out over time? And there's 2 takeaways from this, and one is one that I talk about all the time. But what is interesting is that had you bought a call that was about 8.3% out of the money, and had you spent between 1.3 and 1.4% of the current stock price to buy those calls ahead of each of the last 8 reported earnings, you would have been profitable 4 times, and you would have lost money 4 times. And so you would say, okay, so what? It's a coin flip, 50-50. But that's not the entire part of the story. We don't know for certain whether the stock's going to trade higher or lower out of earnings. But what we can try to handicap a little bit is the magnitude of those moves. And we do have this histogram, it might be showing now. What is interesting is that the average winner, so the 4 times that that trade would have won, the average winner was bigger than the average loss. If you buy an option, the most you can make is essentially unlimited, and the most you can lose is the premium you spent. So in this histogram, what I was illustrating is I was assuming you spent 1.4% of the current stock price to buy it, and what we saw is that the average win was about 2.725%. So 4 times on average, the wins were almost 2.75%. And then, of course, when it lost, you lost all the premium. The stock either went sideways or down, and you lost 1.4%. So you average out all those 8 quarters, what do you get? You get an average return of 66 basis points, 0.66%. And 66 basis points doesn't sound great. You say, well, who cares? 66 basis points. But that's the average return, the average one-day return. So 60 basis points might, 60, 70 basis points might be the average return that you would expect over an entire trading month, 22 trading days. And so you begin to recognize, okay, wait a minute, I see where we're going with this. So I thought this was an interesting trade to highlight, number 1, because we've got earnings coming up. Number 2, because the company's operating performance and growth trajectory seem positive. Number 3, it deserves an options trade because we're seeing a rotation out of the high-flying, high-beta, high-growth names. And we're also potentially at this double top. And this also highlights another point, which is that, and it was based on a question that somebody was asking about selling covered calls going into earnings. Well, imagine that you had been selling an 8.3% out of the money covered call for 1.4% of Netflix's stock price over the last 8 reported quarters. And the fact is, as we can see, yeah, half the time you'd have been better off for having sold that call. But the half of the time that you were not, you would have lost more for having sold that call than you made on the times you won. And so this, look, it's anecdotal. It's just one example. But it is an example of why selling covered calls going into catalysts such as earnings isn't necessarily a great strategy. Even if it does win 50% of the time or 60% of the time. If your losses significantly outweigh the modest gains that you might make on those times that you win, the strategy doesn't work. And an 8.3% implied move for a company this size is pretty big. But I'm not sure it's big enough. History suggests that it isn't. We'll see. So for those of you who are interested in sort of an old school options actions trade, we have an event. We have a little fundamental backstory. We have a bit of a technical setup. I'm not a technical analyst. Looks a little double topish to me, but there you go. And I hope that helps. So from there, hopefully I can take some potential questions. Let's see what we've got. Finwest. Welcome back to Cali. Perhaps you can share your insights on the exuberance from the market party yesterday and the hangover we're feeling today. Interesting thing, I think it's, we talked a little bit yesterday about the fact that I think right now Trump is probably favored to win, but I also would say that a lot can happen over 100 days, and we've had some announcements coming from the current administration which aren't positive for business. If for example, Biden is reelected, it doesn't seem probable at the moment, but let's acknowledge that that is a possibility. So what are some of the things that have come out since that aren't so positive? Well, he did send out a tweet suggesting that he was going to try to hurt what he referred to as valuable tax breaks for corporate landlords. And he defines corporate landlords as corporations that have more than 50 residential rental units. For perspective, I haven't validated this myself, but I did hear it reported that that's 50% of corporate landlords. So 50% of the businesses that are engaged in leasing residential housing would be affected if what he says is true. What did he say? He said if they increased rents by greater than 5%, that they were going to go after these valuable tax breaks. And then there was a follow-up to that saying we're not going to apply that to those who are building new residential housing. Well, this is a form of rent control. Rent control has failed pretty much everywhere it's been tried. The reason it fails is because it creates supply constraints, housing supply constraints. Number one, it doesn't encourage investment in residential housing if you believe that your revenues are going to be restricted. It doesn't provide the capital, essentially, from your existing housing stock to build new. They will often say that the biggest cure for high prices is high prices. Why? Because it encourages more supply. Additional supply helps bring down prices and so on. So that's part of it. But that is actually only part of the reason why rent control efforts tend to restrict housing supply. Here's another reason, which I kind of feel gets discussed less frequently, but it's important. And that is that when you artificially depress rental prices, that can encourage people who have those artificially low prices to maintain that housing stock for their own use, whatever that is. Anybody who's familiar with areas where there are rent controls also knows of rental control abuses by tenants. I know of some personally, I'm not going to call these people out, but I know of people that are immensely wealthy that had rent-controlled apartments in Manhattan for extended periods and just kept them as a pied-à-terre when they had long since left. And that does not happen in a free market, right? If you have an apartment that would normally be going for $3,000 a month, but you're paying $1,100, this happens. You have situations where people have access to these apartments and then they sublet them illegally. So what ends up happening is you restrict supply because you create a deterrent for investment in the space. But you restrict supply additionally because you have people who would otherwise have maybe left or would leave or would seek alternatives who've decided, I have a below market rent, I'm not going anywhere. And so you get people locked in. And I think that's a problem. So that kind of rhetoric hasn't been positive. I also think that there just is rotation generally. There's rotation from some of these high growth names. And I'll give some credit to Bob Pisani because he was making this point earlier today on CNBC. And the point he was making is that if you start seeing circumstances where earnings growth rates slow down, and I talk about this all the time. to me, if you're not growing at least at the rate of nominal GDP growth or inflation, whichever is higher, you're basically treading water at that point. So that's treading water. Anything higher than that is real growth, whether high or low. One of the points I don't think I've made, and he reminded me to make, is that we're always interested in rates of change. And that means that, of course, we're interested in growth rates. We are also interested in the change in growth rates. So if a company has been growing, and that subscriber growth chart, that was one of the reasons I actually put that in, was because what we could see is that, yes, the company was experiencing consistent subscriber growth, but also we could see that that subscriber growth had accelerated recently. And that was the reason why I talked a little bit about that password sharing business, because if that was the reason, what this quarter could reveal is that that growth rate, which had accelerated, could now decelerate. And if that is true, then maybe the multiple is a little bit less, and we need to be more concerned about that double top. So just something to think about there. So I believe that one of the reasons that we are seeing this weakness today is that the rhetoric, which I think a lot of people had hoped would be stepped down, has not been that much, I think. We recognize that there is still 100 days to the election. And, interestingly, and in fairness, we have to say that, both candidates are, they're saying some things which aren't necessarily ideal from an investment markets point of view, or from an inflation point of view, or from a deficits point of view. I think the perception is that the debt and deficits issue is going to be exacerbated no matter what we do. But we're unlikely to see meaningful tax hikes if Trump is the next president, and we're not going to see any reasonable efforts made on the spending side if Biden is the next president. And actually, that's probably true in both cases. And then we have the import tariffs issue. That's on the Trump side. We have regulatory constraints on the housing stock. That's on the Biden side. You put all these things together, and people are saying, hey, wait a minute, maybe there's no ideal outcome. I believe that from an investment point of view, at least, a Republican win would be better. So, for what it's worth. Okay, let's see here. All right, Mike, nice haircut between Slob and Halliburton. Slob being Schlumberger. Which one sets up a better options strategy? Okay, so what are the issues for? Well, let's just talk about them. So these are the two biggest players in the oil services space. Halliburton's exposure to North America, in particular, as a percentage of their overall business, is higher than that of Schlumberger. An anecdote hardly matters, but we used to focus a lot on the oil services space back in my Philex, Amex, and NYMEX days. I was actually a market maker in the oil service index names, and we were the specialists in both Schlumberger and Halliburton. I've always rather liked Halliburton and felt that it traded at a reasonable valuation, and I felt that folks have underestimated the investment on the North America side. But that said, why don't we just take a look at the two here? And so Halliburton, by the way, really hadn't been able to get out of its own way now for a couple of years. So let's just pull up a quick 5-year chart. Actually, I think I have. Let's see if I did this right. I think I saved this earlier. So I know you guys, or some of you prefer candles. So this has got candles, and I've set this one to default to the 150-day moving average. For those of you who are followers of Carter Worth, there it is. And you can see this one's been effectively kind of dead money since 2021, but not outrageously valued. So we can just take a quick peek there. 10 times forward earnings, 8 times EV/EBIT. Notice I've decided I'm going to make a habit of not just going back to the default of enterprise value to EBITDA. And certainly in a business like this, we should be focusing more on depreciation and amortization in any case. And we can see it's trading right around its average historical multiples. I kind of like oil in general, in part because I think there was, it was a left for dead space. And it was a left for dead space because I think a lot of people kind of think of the oil business as, wholly dependent on personal vehicle transportation. So as there was a lot of enthusiasm for EVs, I think that the flip side of that coin was that legacy automakers and oil, were kind of dismissed and ended up trading at relatively cheap multiples. These lower multiples, and it's not like this business is going to go away next year or the year after. And arguably, again, if we're going to go back to the election, and I'm probably going to be doing this a lot until the election and maybe a bit thereafter. We also need to recognize that there are policy changes that can make it more challenging. So CAFE standards, that's the corporate average fuel economy standards, emission standards, things like this have made it much harder. But the fact is, I do think that these companies are reasonably valued. And those valuations, if you don't think that, you're basically buying a declining business, an asset that's just going down, which in some ways for the integrated oils, I'm going to get to that, is true. There is some margin of safety. And, if you can see my screen, and I'm not sure if we are able to blow this up, what I want to draw your eye to is the low multiple. So at the top center, you're going to see 2-year historical premium range. What that table is showing you. So the blue dot represents the current valuation, and the orange diamond represents the historical valuation. In this case, over 2 years, we can just bump this over to 5 and just say, okay, well, how does this company compare to its own valuations over this time frame? The columns, the low and high columns, are kind of what I want you to focus your eye on, because those represent essentially how much lower has the stock been as a turn to its forward, on a forward price earnings basis. How low has the stock been versus how high has it been? And as you take a look at a 5-year history, what you're going to notice is that for many of these multiples, we're towards the lower end of the range. So part of what we're trying to do is establish whether or not we think the company's prospects are good, whether or not we think the street's estimates are reasonable, but also how investors have historically valued a business based on those same numbers. And what we can see here is that for most of these metrics, it's towards the lower end. And what that suggests is that there is a margin of safety. I didn't coin that. In fact, I only just recently read that book, which is out of print and hard to get. But the general idea here is that when you can buy these businesses at the lower end of their valuation ranges, that you create, it doesn't mean the stock's going to take off, but it does mean that the downside is mitigated somewhat. Now, I'm going to just offer something else, which is that I often say this about Kroger. Right? Kroger has traded 10 to 12 times earnings forever. It's in a very stable business. And every single time I think, boy, this is a good time to buy this company, I've rarely been proven to be correct on that. I think actually it has caught a bit, a little bit. Let's take a look. Yep. So, so this is another example. You can see this one's also been. So let's just take a look at Schlumberger. Oh, and actually this is one other quick point I want to make as well. So Schlumberger, bigger business, broader business, better top-line growth. And so less North American exposure. And, for that reason, I think that if you're just thinking about it fundamentally, if all you ever looked at it said, well, could I own one business or the other for the same money, Schlumberger is the one you would rather have. It does trade at a modest premium. We can see here it's trading around 12.7 times forward versus 10 times for Halliburton. And people who know me know that I've often been a supporter of Halliburton and owned the stock on multiple occasions in the past. Don't own it right now. In fact, I've generally owned it. So probably over the course of the last 10 years, I've owned it most of the time. But I sold it a couple of years ago and haven't bought it back. So of the two, my vote is Schlumberger. Hope that helps. So, okay, let me just get to the next question here. Can you increase your audio volume? I think that was resolved, and I'm not the one who controls that. Okay. Hi, Mike. You're doing wonderful sharing your thoughts and analysis. Do you think advisor-managed stocks and options portfolios or portfolio have advantage and add value to an experienced do-it-yourself investor? It can. There is kind of a specific area, though, where I think this is true. So I've managed a 40 Act fund, and that's an abbreviation for 1940 Investor Act. So that's basically a mutual fund. And I can tell you that if you have a fairly rules-based 40 Act fund, I'm not convinced that an institutional investor is going to add a huge advantage in most cases, and the reason is because there's just a lot of handicaps. It's not easy to do. In 2022, we beat the S&P net of fees. In 2023, I don't remember exactly what our returns were. I think we were up about 20%, but the S&P did beat us net of fees. I think we had better risk-adjusted rates of return, but the problem that you face is that if you have a highly restricted sort of systematic investment strategy that you have to adhere to, that's part of the problem. The other is that if you have more sophisticated option strategies, oftentimes you cannot employ them. What would be examples of these? Well, an example of one of these would be situations where you think, as I have and actually did earlier this year, that the ratio in the price, the relationship between the price for index options and ETF options was very low for the index and ETF side relative to the premiums on the single stock side. And that, to me, set up kind of an interesting trade. So that means that accepting through the events, as I often discuss, that I wanted to be net short options premium on the single stocks, long it on the index side, and that's not something that a strategy that is already kind of restricted and highly regulated is going to be nimble enough to adopt. Being able to trade vol is also something that's not going to be that easy. There are other cases, though, where having a professional do it is absolutely something, if you're not trading in the vol space, that you should do. Examples would be if you are in fact trying to trade dispersion or correlation, if you are trying to do statistical volatility arbitrage, if you don't do those things or have not done them, the chances that you're going to be able to do them effectively relative to professionals in that space is relatively low. When I did statistical volatility arbitrage and when I interacted with others who did, a lot of the bigger trades and sort of opportunities to buy on the bid, sell on the offer, set these things up, there's a lot of modeling that goes on, a lot of screening and scanning that goes on, a lot of constant trade management, risk management that goes on. Those types of things are things that professionals are going to likely do better. But that's going to operate more frequently in the SMA space, in a less regulated advisor space, so not in the 40 Act space, and in hedge funds and things like that. So I don't know if that really provides an answer, but I hope that helps. Of course, you can always educate yourself better, and the retail trading platforms, especially the ones I sort of call prosumer platforms, have increased in sophistication enough, and in some cases their long and short rates are good enough that you can actually do these things that wasn't possible before, just because the transaction expense and the interest expense would have been too high. Customer portfolio margining has also made this possible. Okay, don't usually look at diamonds, but the RSI is 83, looking for regression versus SPX and triple Q. Thoughts about a bearish diamond? Well, this is the rotation we've been talking about. So interestingly today, so diamonds, the Dow is not a big index. It only has a handful of stocks. And if you take a look at it today, or this was true earlier, so maybe by the close it's changed a little bit, but most of the outperformance in the Dow was based on a single name. And I believe that was all coming from, oops, I don't want the sector. That was all coming from over here. Where's United Health? I think it was, yeah, so let's take a look. Yeah, it was all, a lot of that performance came from United Health. And that's not showing on this chart because I have some setting that is not right. But I just remembered seeing that United Health, which is a name I typically have liked but hasn't really done all that great lately, did really well today. So it was up about 4.5%. And yeah, you can see right here the performance over the last couple of days. The stock has finally broken out of that, the upper end of that range. Just in the interest of disclosure, United Health is a company that I've followed for a long time, and the reason for that was that back in my days at CRT Capital, which was the credit research and trading CRT Capital, not Chicago Research and Trading. There were two CRTs. One was Chicago Research and Trading, the other was Credit Research. Credit Research, which was based in Stanford, the head of research there was a woman named Cheryl Skolnick. So she was a colleague of mine. She ran the research department. She specialized in the healthcare space and also in managed care companies. She was a strong proponent of United Health for years. I stayed in touch with her for a long time. And she ultimately went and joined the company. So she's an executive there now at United Health. But it's just a really well-managed business and best of breed, in my view, in the managed care space. So that's really where the outperformance in the industrials occurred today. So just and there's other funkiness. I mean, the fact that the industrials are a price-weighted index, I've never really been a fan of it. I've always felt like only once a company sort of became an established player but was no longer a growth story did it get adopted, because our perception of what the U.S. economy is, which is more how the industrials is constructed relative to the S&P, which is just cap weighted, just meant that I always felt like it was one step behind. So I kind of generally prefer Russell 1000 or S&P 500 in the general case. But the good news is that the rotation that we're seeing is more into the industrials now. The RSI, because the industrials outperformance today was propelled by one stock, I kind of think like that's a little bit less of an issue than it might be in other cases. And we can see that there was a definitive breakout here. So, gun to my head in the short, now is probably a bad choice of words given what has been going on in the country lately, but it's a common thing for us to say, forced to choose. How about that? Forced to choose, I would prefer industrials to the S&P 500 right now, if only because of the headwinds. I think that the biggest drivers of S&P outperformance over the course of the last couple of years is that rotation that we were just talking about. Okay, let's see what we got here. Do you think the weakness today in semis is an opportunity to buy? Nvidia, AMD, and Broadcom are all down. Interesting. Well, first of all, the weakness in Nvidia. So let's just pull up a chart of that one really quickly. So they obviously got hard hit. We also had this, again, it was kind of a government thing, and we were talking about what was going on with Taiwan Semi. But, take a look at NVIDIA's chart here. This is the 1 year, but let's just shorten this up a little bit. This is not, it's not like this is today's weakness. Right? This is sort of there's a bigger issue going on here. And to illustrate this, let me just pull the S&P in here. So what do we see? I apologize. I should trackpad hard to do. Trying to get this thing to highlight. How do I get it to do this so you can see this a little bit better? Because I imagine there. Okay, I'm not going to touch it. All right. So, what we can see here is that for a good portion of the recent history, we saw significant outperformance from NVIDIA relative to the S&P, and that situation has reversed. And does this necessarily represent the moment when that reversal from outperformance to underperformance is going to end? Well, here I've just pulled up the RSI really quickly, again, just year to date. If what we're looking for is an oversold condition in some of these stocks, I don't think we're quite there yet. So this might be a way to sort of decide how you're going to, choose those entry and exit points, when you start to see underperformance like we did in this space today. Taiwan Semi, again, there was, that's sort of a political issue going on there. I think I mentioned I kind of like the company, but anyway. I would just wait for a little bit more weakness on the RSI scale before I would actually dip my toe in. Hey, same thing here. So somebody else is also Broadcom. Another name that I like, September 150 calls, down 15% plus from its all-time highs. So again, let's just take a quick look at Broadcom here and see how this one looks. And again, I look at these things, and it's the exact same story, right? When we got that relative strength, way the heck up there, a huge outperformance. We had that gap. And that's the other thing. We haven't completely filled that gap, by the way. So, and it's not. This is not the interesting thing about technical analysis, is that in some ways I don't need to be a technical analyst to at least gain some insight from it, because all I need to know or care about is that other people know and care about it. And we aren't in an oversold condition in either of these two stocks for those who look at it. We have not gotten down to the critical moving averages, which we know other people will look at. We have not completely resolved that unfilled gap, which still others look at. And then we have just the general backdrop. And the general backdrop is that there is this rotation going on. And that hasn't ended. And as I've often said, I've never bottom ticked anything. I've never top ticked anything. I'd rather miss a little bit off the bottom when we get some confirmation. And what did we have? We had a drop gap lower but didn't fill that gap. We closed on today's lows. It's absolutely something to keep an eye on, but I think there's a little bit more potentially to go here. I hope that helps. And we're after 5. By the way, I'm going to probably have to keep this relatively short, simply because sometimes I drift into 5:15, 5:20-ish, and so on. But I am going to be going on to CNBC on the Fast Money later today, and it's going to be within the next 30, 40 minutes. So I'm going to have to jump off of this so that I can join that. But you guys aren't going to need to see what I'm going to talk about, because we already talked about it, and that is Netflix. And I went into a lot more detail here than I'm going to be able to there in the 90 seconds or so that I'm on the air on CNBC. So with that in mind, as always, for those of you who tuned in, thank you very much indeed. I hope all of you are subscribers. And I also hope that you encourage other people that you know or might be interested to watch these, or lend their comments and suggestions on how we can improve it, and subscribe as well, because if they do, then we'll be able to do more of these. And I have some thoughts on trying to get other people and things involved, but in order to do that, we need to drum up a suitable audience. So once again, thank you all for squandering the better part of an hour listening to me drone on, and I'll catch you in the next one, which is, assuming we do everything we can. Let me see here very quickly before I jump, because there was somebody just said one last question, and it was the OptionPlay strength score. Yeah, that's a good point. So I didn't pull up OptionPlay today, and I usually do. Let's just quickly pull that up. So the issue here was about the strength scores, in OptionPlay. And I just want to make a quick point, and that is that, and I'm not discouraging anybody from using those technical indicators, it just doesn't happen to be the ones that I look to first, because when I'm doing my fundamental work, I'm usually using the Bloomberg, and so I'm using other types of technical indicators. These are proprietary. I tend to look at these things once I'm looking to construct an options trade, and I will use this tool to do that because it is just simply a little bit easier than trying to look through the options montage and calculate in my head what various spreads are going to look like at various points in time, because there's not an easy way to construct it in the Bloomberg terminal. But the short version is that does it dissuade me? Not so much, but I think it's a good thing to keep an eye on. Okay, so that'll be the last thing I said. But once again, thank you all for watching. I hope you tune in when we do this next one, which is going to be next Monday, 4:15 Eastern Time. Thanks for watching.